The IRS is sitting on over $1 billion in unclaimed refunds right now. Not penalties, not fees. Refund money. Money that belongs to individual taxpayers who earned it, had it withheld from their paychecks, and never collected it. The typical unclaimed amount is nearly $700 per person, and that figure does not include additional tax credits that could push your total into the thousands. There is one form that lets you reach back, correct the record, and pull that money out. It takes about 20 minutes to complete, and most Americans over 60 have never been told it exists. The form is called the 1040X, and by the end of this, you are going to understand exactly who qualifies, what it recovers, and the hard deadline that will lock you out permanently if you wait too long. Why the IRS has your money in the first place. Here is how this happens. Every year, tens of millions of Americans have federal income tax automatically deducted from their paychecks, their Social Security deposits, their pension payments, and their retirement account withdrawals. That withholding is sent directly to the IRS before you ever see it. If the amount withheld exceeds what you actually owe in taxes, the difference belongs to you. That is your refund. But here is the problem. If you never file a return, the IRS does not send you a check. They hold it, and they hold it for exactly 3 years from the original filing deadline. After that window closes, the money is transferred permanently to the United States Treasury. It is no longer yours. You cannot petition for it. You cannot appeal. It is gone. For the 2022 tax year, the IRS reported that more than 1.3 million taxpayers never filed. The collective refund money sitting and holding for that year alone exceeded $1.2 billion. And the deadline to claim those refunds was April 15 of this year. If you missed it, that particular window has closed. But here is what matters right now. If you filed your taxes in any of the last 3 years and left money on the table, missed a credit, skipped a deduction, or made an error that reduced your refund, the 1040X gives you a second chance to fix it. And for seniors, the list of commonly missed deductions is long enough to make this form worth every minute of your time. The deduction most seniors are leaving behind. Starting with the 2025 tax year, there is a brand new deduction that applies specifically to Americans aged 65 and older. It was introduced through recent federal legislation, and it is unlike anything the tax code has offered this group before. If you are 65 or older by the end of the tax year, you may be eligible for an enhanced deduction of up to $6,000. If you are married, filing jointly, and both you and your spouse are 65 or older, that amount doubles to $12,000. This deduction is available whether you take the standard deduction or itemize. It stacks on top of every other deduction you already qualify for. It does not replace anything. It adds. Let me show you what this looks like in real numbers. If you are a single filer, 68 years old, with adjusted gross income under $75,000, your total deductions for 2025 could reach approximately $23,750. That combines the regular standard deduction of $15,750, the existing additional standard deduction for being over 65 of $2,000, and the new enhanced senior deduction of $6,000. For many retirees, that stack of deductions is large enough to eliminate federal income tax on Social Security benefits entirely. The phase-out begins at $75,000 for single filers and $150,000 for married couples filing jointly. Above those thresholds, the deduction decreases. But below them, the full amount applies. This deduction is effective for tax years 2025 through 2028. That means the first opportunity to claim it is on the return you file in early 2026 for the 2025 tax year. If you already filed your 2025 return and did not include it, you need the 1040X. The credit that has been available for decades and almost nobody claims. There is a federal tax credit called the credit for the elderly or the disabled. It has been part of the tax code for years. It is claimed by attaching Schedule R to your Form 1040 or 1040SR. And the number of eligible Americans who actually file it is staggeringly low. This credit directly reduces the amount of tax you owe, dollar for dollar. It is not a deduction. It is a credit. That distinction matters because while a deduction lowers your taxable income, a credit lowers your actual tax bill. You qualify if you are 65 or older at the end of the tax year, or if you retired on permanent and total disability and received taxable disability income during the year. Your adjusted gross income must fall below certain limits, and your non-taxable Social Security and pension income must also fall below a second threshold. For a single filer aged 65 or older, the initial base amount used to calculate the credit is $5,000. For a married couple filing jointly where both spouses are 65 or older, it is $7,500. The final credit amount depends on your income, but for qualifying individuals, it can reduce your tax bill by several $100s. Here is the part that most people miss. The IRS will actually calculate this credit for you if you ask. All you have to do is check the appropriate box in Part 1 of Schedule R. Fill in Part 2 with your income figures, and write CFE on the designated line of Schedule 3 on your Form 1040. The IRS completes the math and applies the credit. Most tax preparation software does not flag this credit automatically, which is why millions of eligible filers walk right past it every year. If you qualified for this credit in any of the last 3 tax years and did not claim it, the 1040X is how you go back and collect it. Asterisk asterisk how the 1040X actually works. Asterisk asterisk. The 1040X is formally titled the amended U.S. Individual Income Tax Return. It is designed to correct errors or add information to a return you have already filed. You can use it to claim a deduction you missed, add a credit you did not know about, fix an incorrect filing status, or adjust your reported income. Here is what you need to know about using it. You have 3 years from the date you originally filed your return, or 2 years from the date you paid the tax, whichever is later, to submit an amended return and claim a refund. That means right now, in 2026, you can still amend returns for the 2023, 2024, and 2025 tax years. If you missed the new enhanced senior deduction on your 2025 return or failed to include Schedule R for the elderly credit on any of those years, the 1040X is your correction tool. The form is divided into 3 columns. Column A shows what you originally reported. Column B shows the change. Column C shows the corrected amount. You fill in only the lines that are changing. Everything else stays the same. You also include a written explanation at the bottom of the form describing why you are amending. You can file the 1040X electronically for returns from the last 3 years. Processing typically takes 8 to 12 weeks, sometimes longer. You can track the status online through the IRS, where's My Amended Return tool starting 3 weeks after you submit. One important detail. If you owe the IRS money from a prior year, they may apply your amended refund to that balance before sending you the remainder. If you have outstanding child support obligations or certain federal debts, the same offset rules apply. The deductions and credits you should check right now before you decide whether the 1040X applies to you. Go through this list. These are the most commonly missed tax benefits for Americans over 60. The enhanced deduction for seniors, up to $6,000 for individuals, $12,000 for qualifying married couples. Available for the 2025 tax year and beyond. If you filed your 2025 return without it. Amend. The additional standard deduction for age. $2,000 for single filers aged 65 and older. $1,650 per qualifying spouse for married couples filing jointly in 2026. This is separate from the new enhanced deduction and applies automatically if you check the correct box on your return. If you missed it, amend. The credit for the elderly or the disabled. Schedule R. A direct credit against your tax bill for filers 65 and older or those retired on permanent disability. If you never attached Schedule R to any return in the last 3 years and you meet the income thresholds. Amend. Medical expense deductions. If you itemize and your unreimbursed medical and dental expenses exceeded 7.5% of your adjusted gross income, you can deduct the excess. Many seniors pay for hearing aids, dental implants, home health aids, and long-term care premiums that clear this threshold and never claim them. Charitable contributions. If you took the standard deduction and made qualified charitable donations, you may have missed deduction opportunities in years when temporary above-the-line charitable deductions were available. What to do in the next 7 days. Pull out your tax returns for 2023, 2024, and 2025. Look at every deduction line and every credit line. Compare what you claimed against the list above. If anything is missing, download Form 1040X from the IRS website or open it through any online tax preparation service. If the numbers feel complicated, call the IRS directly at their toll-free line and request assistance. You can also visit a taxpayer assistance center in person for free help with the amendment. The agency maintains locations across the country, and appointments are available through their website. The 3-year window is not flexible. Every month you wait is a month closer to losing what is already yours. The form exists. The deductions exist. The credits exist. The only step remaining is yours.